Okay, this is a recording of June 2nd. This is how the morning should have gone. This is what it should have looked like. And we'll go over what the potential is, just using one contract on minis to show what the potential is without adjusting contract size and see what happens by the end here. So we'll try to play it as best we can. So we'll come back to the first trade right here, first signal right here, touching the line, we're going to buy. Stop loss immediately goes down. Take profit goes up right there. We have a, it's a 1 to 1.5 risk to reward ratio, okay? As the market begins to play out here, you can see that there is a support level right here that we are trading off of, which is above this. The minute that this closes below that and our line goes red, we actually get out of that trade, which is right in here. Okay, so we're actually going to close that trade out as that goes red. This is exactly how you do this. Remember, we are blue on blue, so our fill is blue, our line is blue, price comes back to it, we take that trade. Market continues on until we get in here. This market comes back, touches our white line. This is the first time after the market goes red background on the fill, red line, we enter that initial white line here. Our stop loss should be up out of the way in case it comes back to the red line. We can see this previous area of resistance right here. So we can set our stop loss right there. And although not the best risk to reward trade, it does give us an opportunity where if it did come back to the line, we could enter. Okay? Take profit is going to go below here, right here, and we're going to press play. This is the first blood. There we go. First blood hits, moves off of the white line. Market comes back, and right here on the next candle, right there, it's going to give us another trade. We're going to enter here. Stop loss up here. Good entry from the line. There we go. We have our 1 to 1.5 risk to reward ratio trade. Market continues, target hit. This is with one contract, not adjusting contract sizing. Here we go. Another trade. Here's where your initial stop loss would be up here. I'm actually going to slow this down. We don't need to go so fast. So our target's here. As soon as you go blue, right here on this next candle, you can see we have a resistance level right here. That's what we're trading off of. If you see our lines trading off of this level, as soon as we start to get above here and it turns blue, we're actually looking to exit the market right here. It's a $365 loss. As soon as that does that and we go blue, you just get out. Okay, market continues. We could speed it up a little bit because our next trade is not till over here. Market went sideways at this point for a while. Okay, we'll slow it down. Okay, right here, this is where it got tricky. We had a first blood trade that happened right there. So you would have your first entry off of that white line in the market. And then this market came down to touch the blue line. So I'm not going to re-enter. But from that blue line, that's where if it does come to that point, I should have that room for that market to actually have a genuine pullback and not stop me out. Now, if I'm going off of the blue line and I see these levels of support over here, you might not need to risk the full amount. You can just come to where that previous blue line is right there, give it a little bit of distance. And here on this trade, we're risking 325 with the opportunity to make 590. We missed this trade on the call. There you go, touches the line. That's the better entry, but again, we take this on the first blood, so it just happened to pull back on this one. You can see on the previous one, right here on the first blood trade off of the white line, it hits it and continues. This one hit that and it continued to pull back to the blue line, gives the signal, and then it goes on and target gets hit on this one. We're going to speed it up again. Next entry coming up here. All right, we'll slow it down. Last trade of the day. Right there is going to be the entry. I'll pause. From that entry, we set up our Fibonacci, and we know that here's our target right here at the higher high, and it means our stop loss is going to be here, which I like. It's out of reach underneath this previous support level right there. So we're saying the market needs to move from here for this trade to continue. We're not accepting a deeper pullback, and it is out of the way in case there's a sudden volatility spike to the line or below these support levels right here. Okay, touches the line, and after it touches the line, gives a nice push, another touch on the line, and right there, big push. So with one contract, and here's why after this we didn't continue to trade this. I called it because as soon as I see the market give a huge spike, and instead of having momentum, it pulls all the way back down in there on these rejections, I do not want to take those trades once I see that big spike and the pullback back in. It's just not, it's not my bag. It's not what I'm looking for. And it was the right decision this time. And I also wanted to end on a win. I knew the potential after that one. So we ended on the win, called it. Here's the potential. On the one contract, 1 mini, this would be 10 micros. It was $1,265 without changing any contract sizing, just accepting the size of the market and just going for the wins without changing or adjusting, so that way you're modifying. What you'll notice is that when you're trying to enter and modify trades on the fly, you tend to not get as good entry, and you kind of have to know what your contract sizing is going to be before you get in to try to make sure you get good entry and not adjusting it afterwards or adding or subtracting after you get in. It can be kind of challenging. So for some people, if you want simplicity, you just keep the same contract sizing. And what that means is sometimes, like for example, if this trade had gone on to win, that would be a huge win. Okay, it would be a huge win. But if it loses, it's a huge loss compared, like this loss is 129 ticks. Well, right here, you're only making 61 ticks if you're not changing your contract sizing at all. So it may be challenging to add or subtract your contract sizing on the go. It's definitely the more profitable way to do things to manage risk and manage just the overall outcome of the day. But even not doing that, you can see this was a profitable day when you execute Pathfinder Ultra the way that it is made to be traded. So that's your recap of this trading day. You know, watch this video as many times as you need to go over. Overall, it was a 66.6% win rate when done correctly. And even just same contract sizing, 1 mini, it provided $1,265 of just same contract sizing and letting the outcome play out. Remember that when you get in these trades, blue on blue, coming to the line, it'll give you the triangle. That's when you enter, okay? The triangles do not always trigger exactly at the line. Sometimes they trigger right near the line. But what it is you need to just use common sense and look at the support level and know that your line is going off of those dynamic support and resistance levels in the market. All right, I hope you enjoyed this video. I'll see you in the next one.